Asia Pacific's asset and wealth management industry recently saw Citi add over 15,000 new clients to its wealth division in APAC. More banks in Singapore offer lifestyle credit cards to their high-end clientele. Hong Kong release its FinTech roadmap for the next 12 months. And China's national team mobilized for another battle against the market. Let's take a deeper look at these, as well as other headlines and developments. Starting off in APAC, Citi Global Wealth, the wealth management division of the US bank, noted that it had added over 15,000 new clients across Asia during the first half of 2023, with 36% year-on-year growth occurring in the second quarter of that year. Over the first quarter, revenue growth was 20% quarter-on-quarter, but fell to 4% over the second quarter, quarter-on-quarter. Growth in family offices has been a significant contributor to growth, with the segment seeing a 40% increase in these clients over the 2 years to October 2022, with Singapore a major growth center for the segment. According to Citi Private Bank, the business unit of Citi Global Wealth, which serves clients with $10 million of investable assets and total net worth of $25 million or up, it will expand the services and capabilities in the Citi state, especially around philanthropy, to better cater to those in the investor segment, particularly as many arriving in Singapore reportedly do not know where to start. The private bank unit of Citi Global Wealth added 350 clients across Asia in 2022, and 2023 expected to see more onboarded. Citi Global Wealth currently services circa 400 family offices in Asia, around 25% of their total global client base, and these have average assets per office of $3 billion. Next up, following the news that HSBC, a British financial institution with historical ties to Hong Kong and China, is re-entering India's wealth management space, others are following suit or expanding their presence in the subcontinent, with UBS and LGT, a Swiss bank and the largest royal family-owned private banking and asset management group in the world, respectively, making such announcements. UBS, via its acquisition of Credit Suisse, both Swiss banks, returned to India's wealth management industry after a near 10-year absence and is planning to rebuild its onshore team, hiring 7 relationship managers to bring onshore headcount to 25, as well as headcount in the product team for portfolio management services in order to create more products to target wealthy Indians. LGT is also planning to expand headcount and double AUM in the market, with the target of $3 billion in AUM by the end of 2024. Recent legislative changes in India allow for investments of a certain wealth level to make offshore investments via limited liability partnership vehicles. LGT noted that wealthy families tend to keep their assets domestically and that they were looking to assist in spreading investment risk across other products, especially as clients are shifting from physical assets like gold and real estate to financial assets. Currently, LGT manages the assets of circa 1,200 families and has 85 private bankers across 14 offices. The state of Uttar Pradesh is a particular target given its dense population and growing assets outside of India's traditional Tier 1 cities. In addition to local clients, the banks will target India's diaspora and provide global clients with exposure to investments in India, something that the bank described as a potential game changer. Whilst margins in the market may be lower than others they operate in, firms are enticed by the potential to manage both the business and personal assets of India's wealthy. Within India, wealth managers are targeting clients outside of the traditional centers of wealth, namely Mumbai, New Delhi, and Hyderabad, as increasing numbers of millionaires are emerging in second and third tier urban areas. Between 2020 to 2021, the number of millionaires in India increased to 796,000, up from 689,000, according to data from Credit Suisse. And there are an estimated 17 million individuals with a net worth of over $100,000, an area of particular interest to private bankers and wealth managers. Moving on, several markets in ASEAN are facing challenges regarding the recruitment of private bankers and wealth managers, with Malaysia, Thailand, and the Philippines all struggling for talent in their comparatively nascent wealth management sectors. In one example, Bank of Singapore, the wholly owned private banking arm of Singaporean bank OCBC, opened its private banking business in Malaysia in June 2022, and retaining talent remains a significant challenge, as relationship managers who have clients with sizable AUM are able to move between private banks, seeing substantial asset rotation within the industry, and recent graduates are attracted to new career paths, such as being online influencers. Accordingly, industry observers believe wealth managers will need to incentivize private bankers to stay via compensation, internal platforms, and technology, among other metrics and measures. As increasing numbers of wealth managers, both foreign and domestic, are likely to establish a presence and operations in Malaysia on the back of a forecast 46% increase in ultra-high net worth individuals between 2021 to 2026, the talent pool will likely deepen. Until then, upskilling existing talent so that it understands new assets, markets, concepts, and structures may be the best option for those seeking talent, something that established entities have been pursuing in recent times. In Thailand, the severe shortage of relationship managers derived from the influx of foreign wealth managers into the market is making it challenging for local firms to attract and retain talent. As the competitive landscape becomes increasingly competitive, with rising affluence among the local population driving Thai banks to focus their attention on wealth management, and increasing numbers of foreign wealth managers entering the market, smaller banks and other financial institutions like securities and insurance brokerages have been drawn to the segment. Examples of foreign players include BNP Paribas Wealth Management, HSBC Global Private Banking, Julius Baer partnering with Siam Commercial Bank, Lombard Odier pairing with Kasikorn Bank, and Pictet aligning with Bangkok Bank. Industry participants note that demand is growing faster than training and development, and that foreign players are driving up wages in the sector as they want to employ experienced hires and entire teams. Local players reportedly find it challenging to compete for the higher salaries offered by their foreign counterparts, as well as the wider range of products and services that they offer to clients. To redress this, wealth managers are encouraged to implement adequate frameworks to attract and retain relationship managers once they have built a presence and client books, with attractive incentive programs seen as key to this. Following the experience of Malaysia, several private banks are looking to retrain corporate and retail bankers to deepen their talent pools, though it is noted these staff are not always best suited to interact with wealthy clients. To redress this, some wealth managers also hire investment managers to work alongside relationship managers. Also, as in Malaysia, newcomers to the industry and experienced professionals alike need to be aware of the demands of the increasingly sophisticated, younger, digital native clients, who, whilst they may be avid users of digital platforms, still rely on advice from qualified professionals. Industry experts noted that the client segment with AUM in the 1.5 to 3 million US dollar range was an industry sweet spot, largely as this level of assets made clients profitable from the get-go, as they were qualified to invest in a wide range of investment products. Some industry players, including foreign wealth managers, set their target range in the 2 to 5 million US dollar band, with factors like salaries, internal infrastructure, and increasingly onerous compliance requirements driving the higher baseline for client assets. The Philippines is having a similar experience to its fellow ASEAN members, with rising competition caused by foreign wealth managers and smaller domestic players entering the market, leading many private banks to focus on developing their own and retaining existing talent. Whilst the traditional solution of poaching talent from other entities has long been a favored solution, the spike in demand makes this increasingly infeasible as salaries rise in response. Those in the industry see a unique relationship manager development strategy as crucial in attracting and retaining the next generation of investors, who, as seen in Malaysia and Thailand, are interested in non-traditional assets, are purpose-driven regarding their wealth, have higher expectations of their private bankers than their parents, and are increasingly digitally savvy and focused. Wealth managers across ASEAN are increasingly responding to demands from clients who want a private bank who is a technology leader with a fast and comprehensive digital proposition able to deliver a personalized experience. This is matched by demands from the relationship managers hired by said wealth managers who increasingly expect digital infrastructure to facilitate painless client onboarding and fast execution of trades. Accordingly, private banks have invested substantially in their technology offerings, something that the COVID-19 pandemic accelerated. Increasing developments and adoption of AI may prove a boon to wealth managers across several factors: improving client service, enhancing technology propositions, improving business efficiency, and driving cost savings. How wealth managers across ASEAN are able to effectively manage their talent and technology needs against client demands remains to be seen. Over to Singapore. Following the announcement and subsequent launch of Citi's Ultima MasterCard, UOB, a Singapore financial institution, is stepping up its efforts in targeting high net worth individuals with lifestyle products in a similar vein. Following its acquisition of Citi's retail operations across 4 ASEAN markets, the Singaporean lender will shift Ultima holders in those countries over to its own UOB Reserve card. Other invite-only cards outside of Ultima MasterCard and the UOB Reserve cards include the American Express Centurion, Citi Ultima, the first iteration of the card issued in 2010, the DBS Insignia, and UOB Reserve Diamond. Concierge services are seen as a unique benefit to the cardholders, sourcing exclusive experiences and items, including tickets, private jet bookings, golf course access, and more. It was noted that banks offering these cards would need to supplement their private banking experience in addition to the ancillary benefits and services in order to maintain their edge in an increasingly competitive market. It was further noted that despite comprising 0.5% of UOB's total cardholder base, UOB Reserve holders contributed to more than 10% of total credit card spending in 2022 and spent 15 times more than other UOB cardholders on average. So the effort to grab and maintain clients at this level is likely worthwhile. Up to Hong Kong. The Hong Kong Monetary Authority, Hong Kong's de facto central bank and financial regulator, published a new FinTech promotion roadmap outlining the key initiatives that it will undertake over the next 12 months to further boost FinTech adoption and development in the SAR's financial services industry. The roadmap focused on 3 areas: wealth tech, insurtech, and green tech, as well as the specific technology of artificial intelligence and DLT. And the HKMA worked closely with the SFC, Hong Kong's Securities and Futures Regulator, and the IA, the regulator for the insurance industry in the territory, along with Quinlan and Associates and KPMG, a consulting company based in Hong Kong and a global network of firms providing accounting and consulting services respectively. Following its release, the HKMA will start taking more practical steps to help financial institutions in their FinTech adoption and implementation, moving beyond its current focus on promotion and awareness raising. The roadmap builds on the HKMA's FinTech 2025 strategy, an initiative focused on encouraging the financial sector to comprehensively adopt technology and deliver fair and efficient financial services for the benefit of Hong Kong's people and economy by 2025 across 5 focus areas. This includes the launch of an online knowledge hub, enabling financial institutions and other FinTech stakeholders with relevant information alongside research, seminars, and promotional activities. Industry participants welcomed the announcement, with some noting that it aligned well with their existing investments in FinTech and further stating that customers would be the ultimate benefactors from such a drive. Following the launch of FinTech 2025 2 years ago, the HKMA reports that 84% of banks have adopted RegTech, and the HKMA is confident that the next 12 months will see greater use of technology over the areas covered in the roadmap. Where the roadmap takes Hong Kong and the wider FinTech industry will be interesting to see. And now to China. Following the US $900 billion wipeout in Chinese onshore stocks, in which foreign asset managers sold 77.9 billion renminbi over 13 consecutive trading days via the Stock Connect program between Hong Kong and mainland China, the longest selling streak since data compilation began in December 2016, and something that would no doubt make Thanos proud. China has once again mobilized the national team to pick up the market slack, among other initiatives, to boost growth and shore up investor confidence. The CSRC, China's main securities regulator, has called on the National Pension Fund, banks, and insurers to expand their mid to long-term investments in the stock market, summoning executives of the financial institutions to discuss how to better address institutional barriers preventing medium to long-term capital from entering the market. CSRC stated that it would work with relevant departments to relax restrictions on the amount that insurance and pension funds can invest in equities, and to actively guide financial institutions as they look to implement long-term performance measures and assessments. Additionally, at least 14 fund management companies and 3 securities firms have promised to purchase units in their own equity-focused public funds, investing at least 1.05 billion renminbi into the products. FMCs made similar moves in previous years when China's stock market swooned or collapsed, though industry analysts note that this time actually may be different as the market is suffering from a lack of confidence, to which there is no clear fix visible. Some thought the moves by the fund management companies were meaningless given the amount of money at stake, with FMCs seemingly committing between 50 million RMB to 200 million renminbi each, though others took the buybacks as a sign the market had reached its nadir and, whilst not indicating a turnaround, pointed to stabilization at the least. Further to hauling Chinese financial institutions in for meetings, CSRC met with foreign investors in Hong Kong in an attempt to have them support the market along with the national team and address the massive outflows the market is seeing. At least 6 foreign managers reportedly attended the virtual meeting, including Fidelity and Goldman Sachs, where CSRC sought to provide reassurance to participants regarding China's economic prospects. Despite owning less than 4% of China's domestically listed shares and accounting for circa 6% of total onshore turnover in the year to date, foreign investors have been targeted by a Chinese hedge fund manager, noting that, taken together, they are a bunch of aimless flies, in an article published on a social media site. In the article, the author praised the actions of the PBOC, China's central bank, in lowering the 1-year loan prime rate, though the 5-year rate was left unchanged, something that markets reacted negatively to and which may have contributed to the sell-off. Foreign capital was noted to be more fanatical than the domestic variety, and foreign investors had no judgment, serving only to add to market volatility and bringing no positive effects. As such, they were the main reason for current market conditions, according to the article's author. August saw foreign investors sell a record 90 billion renminbi in shares on the Shanghai and Shenzhen bourses, generally seen in response to lackluster measures from policymakers to shore up China's financial markets and economic outlook, as well as salvage the debt-ridden property sector. In addition to rate cuts, policymakers have cut stamp duty on share trading to 0.05%, a 50% cut and the first reduction since 2008, when it was cut from 0.3% to 0.1%, with the proposal reportedly first tabled in early August. Regulators also slowed the pace of IPOs, though economic and market forces were driving this already, with the objective of promoting the dynamic balance between investing and financing. IPOs in China are seen as driving down bourses as investors sell existing holdings to buy into the newly listed entities, and IPOs were suspended previously in similar situations in 2013 and 2015. This time, the measure is expected to be gradual, so IPOs will not be completely halted and will be dependent on market conditions, something that the 650 plus firms waiting to list on the Shanghai and Shenzhen exchanges will no doubt be thrilled to hear. Industry participants noted that whilst such a move may provide the market with a temporary boost, potentially pushing the A-share market up by 2 to 3% and inflating brokerages' annual profits by between 120 to 130 billion renminbi, the long-term effects would likely be negligible, and that only changes to underlying economic conditions and other market reforms, such as addressing IPO pricing, excessive financing of listed companies, and false information disclosures, would reverse the current situation. The minimum margin ratio for stock purchases available via margin financing was also lowered to 80% from 100%, taking effect from September 8, extending trading hours for stocks and bonds and encouraging share buybacks were also considered. However, policymakers are taking the view that a stable stock market was a key factor in improving overall sentiment and market revival. Securities brokerages are joining in, with CITIC Securities, a Chinese full-service investment bank, cutting fees charged to investors for those trading on the Shanghai, Shenzhen, or Beijing exchanges. The cuts are calculated to save investors a whole 0.146 renminbi for every 10,000 renminbi in transactions and reflect the aforementioned cuts made by the bourses themselves. CITIC does not appear to be taking any financial hit with the move. Adding to the woes of China's financial sector is the news that the fiscal situation of Zhongrong International Trust Company, a large Chinese integrated financial service provider, may cascade through the 2.9 trillion US dollar trust industry, with Goldman Sachs estimating that up to 38 billion US dollars in trust products may be written off. The sector has been restructured a reported 6 times since 1979 and was a key area of focus from regulators when super guidance reforms began. Whilst 7.4% of total trust assets are directly invested in property, more may be allocated via bonds and equities, and it is estimated that 1.6 billion renminbi had been lent to property developers by trust companies as of end March 2023. Further, trust products linked to real estate and property investments comprised over 70% of such product defaults. With the reported debt to GDP ratio over 300% and interest payments amounting to circa 14% of GDP, many are looking to the current conflagration as China's Lehman moment, referring to the point at which one entity's crisis suddenly becomes everyone else's, referencing the collapse of the former US investment bank at the start of the global financial crisis back in 2008. Some feel the moniker is appropriate given the link between property firms, trust companies operating as shadow banks, and the local government financing vehicles which rely on the first two for financial support. This relationship has resulted in massive off-balance sheet debt, estimated by the IMF at between 30 to 70 trillion renminbi, and over 25% of such LGFVs reportedly do not have enough operating reserves to service even their on-balance sheet debt, reported at 37 trillion renminbi as of April 2023, with revenue from land sales falling 20% over the first half of this year. Ray Dalio, founder of Bridgewater Associates, an American investment management firm, and self-proclaimed China Bull, noted that the crisis presented China with an opportunity to undertake a beautiful deleveraging, seizing the moment to undertaking debt restructuring, something which he believes the Middle Kingdom is overdue for since the last one in the 1990s. Mr. Dalio's own firm disposed of more than 14 million US dollars worth of China investments over the second quarter of 2023, following a more than 1 billion US dollar sell-off in the second quarter of 2022. Others do not draw the same parallels and see the current situation as a crisis of consumer confidence, the solution to which is for Beijing to loosen the fiscal taps and start spending. The fund manager critical of the role of foreign investors in the crisis noted that the current market downturn was not the beginning of the risk at all, but rather the end of this round of adjustments to the shadow banking system, before going on to state that this showed that foreign investors had no integrity at all due to their sudden rush back into China following its reopening. The effect these measures have in restoring confidence in the markets, along with the response of foreign financial institutions, will be interesting to see unfold. Up next, in 2021, shortly after becoming the first foreign asset manager to receive public fund manager license via its wholly foreign-owned entity, BlackRock's CEO, Mr. Larry Fink, referred to China as one of the biggest opportunities. Now, BlackRock's public fund unit ranks around the lower quartile by AUM of the circa 200 public fund managers in the Middle Kingdom, with the operations of Fidelity International and Neuberger Berman, an international investment company headquartered in the UK, and a US asset manager respectively, who followed BlackRock in receiving a public fund management license, ranked even lower. Fundraising by foreign fund management companies has proven disappointing, with BlackRock's inaugural fund launch in September 2021 raising 6.68 billion RMB across over 110,000 individual investors. The fund's AUM has fallen by nearly 50% as of June this year, with a mixture of outflows and a negative 30% return contributing to the decline. Despite its reputation and that of others outside of China, BlackRock's lackluster start is emblematic of other Wall Street giants whose dreams of Chinese riches seem to be fading. This is due to a range of factors, including local companies increasingly turning to Chinese brokerages for domestic investment banking work, which has slowed to a trickle for many American investment banks, overseas investors losing their appetite for Chinese assets following a slowing Chinese economy, and increasing difficulties regarding data access and transmission. The prohibition of American investment in some Chinese companies via executive order and calls from House committees to widen the ban, along with threats of subpoenas against BlackRock and MSCI, an index provider, are unlikely to assist. The current situation is a stark contrast compared to a few years ago. Back in this before time of 2020, restrictions on US asset managers selling public funds to individual investors in China and foreign ownership of domestic securities firms were relaxed. Following this, Goldman Sachs took full control of its onshore securities venture in 2021, and Morgan Stanley increased its stake in its Chinese securities venture to 94% in 2022. Though despite the loosening officially of ownership caps, industry analysts remained skeptical that China would allow a fully owned foreign firm to thrive in the industry. This hypothesis has been borne out by an extended period of poor investment banking revenue, with Goldman Sachs, Morgan Stanley, and JP Morgan all reporting revenue declines in their Chinese domestic ventures investment banking business over 2022. The value of work matches the volume, with Goldman Sachs' venture leading or co-leading 7 initial public offerings in China's domestic market in the past decade, including 1 last year. JP Morgan's unit led 2 deals last year, whilst Morgan Stanley had none. By contrast, CITIC Securities led 57 IPOs in 2022 alone. In the cross-border space, things are also relatively dire, as overseas investors' interest in investing in China declines, with foreign investors' net purchases of domestic Chinese equities amounting to $12 billion in 2022, reportedly the lowest amount since 2016. Chinese bonds saw massive outflows, amounting to $84 billion in 2022 and reached $20 billion as of end July this year. Increasing geopolitical tensions are likely to see the current state of affairs continue for the foreseeable future, with some seeing the recent crackdown on foreign consultancies by Chinese authorities as a precursor to foreign banks potentially being shut out of parts or all of China's financial system. Over in China fund news. In public funds, star fund managers in China have seen assets under management fall nearly 25% over the past 2 years, and retail investors are pissed. The top 10 equity fund managers had a combined AUM of 542.3 billion RMB as of end June 2023, down from 715.6 billion RMB as of June 2021, as per data from Wind, a Chinese financial information provider. The number of equities-focused portfolio managers in China with AUM over 10 billion RMB has also decreased, reaching 141 in June 2023, falling by more than 1 dozen since the beginning of the year. Further, only 5 funds have assets under management over 50 billion RMB, and none have assets over 80 billion RMB. Fund manager Liu Gesong of GF Fund Management has been targeted for special criticism by retail investors, with screenshots of his declining fund portfolios doing the rounds on Chinese social media. The end of 2020 saw Mr. Liu's total AUM reach 84.3 billion RMB, and as of June 2023, it had reached 46.1 billion. Additionally, 9 of China's top 10 worst performing funds are managed by him, having lost between 26.2% to 32.9% in the year to date, with his flagship funds seeing the worst performance among his peers in the year to date, the past 12 months, and the last 2 years. Another data provider noted that since the beginning of 2023, only 11 funds out of 89 managed by China's top 10 fund managers had delivered positive returns. 70 of the funds had seen negative returns of more than 10% since January 2022, and 37 were down 30% since 2021. Industry observers believe the losses are due to being overweighted in medical, consumption, and new energy sector investments, which investors have shied away from recently, switching to smaller thematic funds tracking hot sectors. The reversal of fortune comes as the star managers initially enjoyed a strong start to the COVID-19 pandemic, with a larger social media footprint, live streams, which in some instances attracted hundreds of thousands of viewers, and other forces boosting their profile and AUM. Over the second half of 2021, 8 such equity managers had portfolios of at least 50 billion RMB, and 3 managed AUM over 100 billion RMB. May 2022 saw the decline begin in earnest, with regulators cracking down on live streaming and stock markets collapsing. Many commentators on social media expressed their delight at seeing the shine come off the former star managers. Moving on. In contrast to their equity fund peers, Chinese equities ETFs saw 300 billion RMB in net inflows in the year-to-date to mid-August, with the May to August period accounting for circa 90% of this, and each month setting record highs. The first half of August has already seen net inflows of circa 79 billion RMB. Broad-based ETFs have proven to be particularly popular thus far, with products tracking the CSI 300, SSE Star 50, and Chinex seeing the most net inflows at 50.5 billion, 46.4 billion, and 28 billion RMB respectively. Despite the CSI 300 being at a relatively low level historically, recent announcements by regulators and policymakers may see it rise. Over in private funds, assets in China's private fund industry reached new highs in July 2023, even as regulators sought, once again, to rein in the industry, and as the number of private fund managers fell to a 6-year low. Private fund AUM stood at 20.82 trillion RMB as of July, up 50 billion RMB from the month prior, and up 790 billion RMB in the year to date. Private equity and venture capital firms saw the strongest growth, increasing AUM by 1.4 trillion RMB to reach 14.36 trillion RMB over July. Chinese hedge funds, by contrast, declined by 70 billion RMB to 5.88 trillion RMB in assets under management. The number of private fund managers in the market decreased slightly, falling by 118 over the month, which took the tally for the year to a decline of 1,671, and total private fund managers to 21,996, the lowest since November 2017, when the number last dipped below 22,000. Regulators are stepping up their efforts to remove PFMs, which are seen as fake and badly run, from the industry, and have also implemented new rules regarding minimum capital. In China fund manager updates, having received regulatory approval to establish a 100% wholly owned retail fund unit in January this year, and receiving its public fund manager license in June, Schroders, a British asset manager, is now seeking approval from regulators to launch its inaugural product, one which will be largely invested in bonds. This asset class is something that industry observers note is an indication that the UK asset manager is playing things safe, with BlackRock and Fidelity opting for funds which were heavily invested in equities for their inaugural product launches in 2021 and 2023 respectively. Both of these funds have seen negative returns since launch, and Fidelity's product secured just 1.08 billion RMB in fundraising on launch in April. Neuberger Berman, on the other hand, launched a fixed income fund in March this year, which saw over 4 billion RMB in fundraising. Given the current poor market conditions in China, investors are shifting their focus towards fixed income strategies, with 19 fund launches seeing initial fundraising in excess of 1 billion RMB. All of these have been fixed income or index products. Schroders would be the fourth foreign asset manager to launch a fund in China, following the establishment of a 100% owned retail unit. With another 4 either looking to launch products or receive regulatory approval to establish their onshore operations, the success of different strategies will no doubt be closely examined. Next up, Allianz Global Investors, the asset management arm of the German insurer, has received regulatory approval to establish a 100% owned public fund operation in China, the 6th foreign firm to do so, with the unit having registered capital of 300 million RMB. The announcement came just 5 months after the German investment manager applied for the license, one of the fastest issuances made. By contrast, AllianceBernstein, a US asset management, research, and private wealth management firm, was kept waiting for more than 2 years before it received its license in March last year, though COVID-19 likely played a significant role in that delay, as it hindered in-person inspections and processing by officials. Allianz GI holds a 49% ownership stake in CPIC Fund Management, an FMC with assets under management of around 272 billion RMB as of end 2022, with China Pacific Insurance Group holding the remaining stake. What Allianz GI, as well as other foreign asset managers with FMC joint ventures, in addition to their own 100% controlled retail units, does with its joint venture will be interesting to see. Up next, Blackstone, the world's largest alternative asset manager, registered a QDLP entity in Shanghai, enabling the alternatives manager to fundraise locally and invest the monies offshore. The entity has reported registered capital of $2 million and 7 employees, 5 of which hold China's fund practitioner's license. The entity is 100% owned by Blackstone's Hong Kong operations and was formed in March 2023. The QDLP quota allocated to the entity is currently not known. Blackstone currently has another entity on the mainland, a private fund manager, also with registered capital of $2 million, and this has assets under management of less than $500 million via one product, which is reportedly to be liquidated. This private fund manager entity has 24 staff, 4 of which hold the fund practitioner's license. Next up, given the dominance of top fund management companies in China's public fund market, smaller firms are increasingly heading inland to cities outside the usual Tier 1 centers as they look to expand their market in areas with lower fund penetration. Specifically, a group of 15 cities, referred to as new first-tier cities, are targeted for growth and basing the middle and back office functions of FMCs, whilst traditional first-tier cities keep the front office operations. The moves follow as regulatory changes to fees fund management companies can charge stand poised to reduce the revenues of smaller fund managers, so shifting middle and back office operations to lower cost centers can help in this regard, as well as opening up new markets for them. And finally, China's asset management industry has experienced sweeping changes of senior management over 2023 thus far, with 1/3 of public FMCs having their CEOs depart, and the moves attributed to increased scrutiny on performance and tough competition across the industry. Data from Wind shows 238 senior management changes across China's 160 FMCs, with 90% of these being the chairman, 53, CEO or general manager, 61, and deputy CEO or general manager at 93 respectively. This compares with 2022, which saw 64 CEO changes, 126 deputy CEO or general manager moves, and 81 chairman shifts. As competition intensifies, senior executives are enduring greater scrutiny and changes have become more common. So, that is what we saw across Asia Pacific's asset and wealth management industry this episode. Do let us know your thoughts in the comments below, and if there was something that we missed pointed out to us. A very special thanks to Sam for helping with the episode's research. Thank you all for watching. We hope to see you next time.